It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world. You get to speak to the smartest people like you trying to figure this out, but also the people on stage. They're the experts. So we get all of that, all in one place, in Singapore. What more can you ask? See you at Token 2049.
Hi, everyone, and welcome back to Real Vision and this macro deep dive. My name is Andreas Steno, and I always look forward to host a true gentleman, but also one of the best macro watchers out there, Darius Dale of 42 Macro. It's great to see you again, mate.
Great to see you, brother, and thanks for the super kind introduction. I don't know if I deserve that, but I'm great to be here, man. Thanks. It's always good to be here with the Real Vision gang as well, so hope all is well on your end.
Darius, we had a tumultuous last week in US macro markets. We had the CPI report out, and we also had the retail sales report out. And it seems like we're kind of standing at crossroads here with inflation softening a little bit, but also some signs in some of the reports that we get from the US economy of cracks appearing. So how do you view the US economy after this week of data?
Yeah, that's a great question. So I agree with the characterization that we are at a crossroads from a fundamental standpoint. We are sort of cresting off the top of what has been a very positive, uninterrupted string of accelerating growth dating back to the second half of 2022. Recall that we were on the right side of that when we authored our resilient U.S. economy theme back in the summer of that year. And we're sort of kind of getting towards the end of that process, albeit we don't necessarily agree with a lot of the bear point out there that the U.S. economy is in or near a recession. We do expect growth to slow, but we expect growth anticipate that growth will generally surprise consensus expectations to the upside throughout the duration of our next 12-month forecasting horizon. And at some point that'll change. Either consensus expectations will catch up to ours, or we'll eventually kind of merge towards the end of that process. But for now, we are seeing growth with a negative delta. But again, that delta is not as bad as what consensus is currently expecting. On the inflation side, we have been appropriately calling for inflation to slow and surprise consensus expectations to the downside. We got that obviously with some elements of the PPI and CPI reports this week, and those are confirming of our expectation. We are starting to, at least according to our models, get towards the end of the inflation decelerating process. Currently, we are expecting inflation to sort of meander lower over the next couple of months before kind of bottoming. And once we get into the first half of next year, our projections show that inflation will really start to accelerate again. And that's consistent with how inflation has historically behaved in the business cycle. There's really no time series history of inflation breaking sustainably below trend in the absence of a recession. And so in the context of our deep dive on the business cycle, we are going to stick with that view and our current model projections for inflation to start to really accelerate again in the first half of next year. That's wildly divergent from consensus, which is essentially calling for a very adorable and sort of a perfect return to 2% inflation. We take offense to those projections, but again, we don't think there's really any market risk to deal with now as a function of that. We think that's more of a first half of 2025 trade. So we can unpack any of that as you like and kind of drill down from there.
So there is one question related to the inflation cycle. We're currently, say, between 2.5% and 3% inflation. And it seems like we're a couple of weeks away from the Federal Reserve commencing a cutting cycle. Does that mean that the Federal Reserve is no longer truly committed to 2% inflation? Or how do you read that cocktail of inflation above target and the cutting cycle commencing?
Yeah, no, it's in our opinion, we think the Fed is kowtowing to fiscal dominance here in this forward turning regime, which is exactly what the Fed has done historically in forward turning regimes. I recall that one of the key dynamics that investors should anticipate in a forward turning is an explosive growth of public debts and deficits, and the Fed and how those debts and deficits contribute to above trend inflation. And as a function of that, the Fed has to use its balance sheet, use its monetary policy toolkit to engineer excess demand for treasuries in relative to where the actual market demand for those securities might be. And so as a function of that sort of fork-turning style monetary policy, we do not believe the Fed actually wants the U.S. economy to return to durably to 2% inflation. We ultimately understand that in order to get a durable trend of 2% inflation, you would obviously have to slow past 2% from these levels so that the mean of the time series goes to 2%. And in order to do that, you would obviously have to push the U.S. economy into a downturn. And we do not believe there is any political will on the Federal Reserve Board to push the U.S. economy into a downturn. So this is something we've been talking about, Andreas, here at 42 Macro since the beginning of 2022 when we authored our sticky inflation theme. Well, the key takeaway from that theme is that we are probably going to have a jump condition higher in the underlying trend of core PCE, i.e. that inflation wasn't transitory. Recall that that was a debate back then. And so I think we've been proven right on the fact that inflation was not transitory and ultimately it's likely to settle out at a level that is inconsistent with the Fed's 2% target. But again, we don't believe that they are willing to do what it takes to push the to generate 2% inflation on a sustained basis. We think 3 is the new 2. And ultimately, we're going to figure that out as investors as we progress throughout 2025. But again, I don't know if there's any market risks today to deal with associated with that.
You want to unfuck your shit? This is live.
Yeah, that's being recorded. Hey, listen, if you want to unfuck your future, then come and join us in the Real Vision community. Incredible platform, amazing content, some of the smartest people in the world, and amazing tools. And guess what? It'll cost you nothing. Come to realvision.com. I'll see you there, and let's help you unfuck your future.
Darius, looking at the details from the last inflation report, a couple of the good old culprits, shelter costs and transportation services, kept the inflation momentum intact to a certain extent. So how do you view the path towards 2%? Is it even a feasible scenario to discuss PCE inflation at 2% before year end? Or how do you view the path given these shelter and transportation services components still being elevated?
Yeah, I mean, so we could see 2% inflation by year end, and we already have below 2% inflation when you look at it on an annualized basis. Specifically the 3-month annualized rates of change for headline and core PCE are already at or below trend. But we just do not believe that they're going to durably stay there if the economy continues to expand, because that's kind of the historical progression of the business cycle. So let's kind of talk about the business cycle and how inflation has historically sort of evolved in the business cycle. Because I think that's a really important determination to how investors should be thinking about inflation from a kind of 1 year forward plus time horizon perspective. So if you throw slide 44 here on the screen, Nick, where we show our business cycle analysis. So what we did a big deep dive study to help our clients understand how the business cycle works and how the various cycles within the business cycle work. And essentially the study involved stacking the time series on top of each other instead of sort of analyzing them in linear format so that we can assess how they have historically evolved in and around business cycle downturns and in and around business cycle recoveries. And so this chart on the left just shows the median trailing 10-year delta adjusted Z-score in months before and after recession, before with 0 being a recession. And so what we mean by delta adjusted is that, we just invert things that are rising, that are countercyclical to the business cycle so that the chart is easier on the eyes. And so in terms of how the business cycle works, typically you have policy sort of breakdown, or in Fed interest rate terms break out kind of about 15 to 18 months ahead of a recession. Then you have corporate profits breakdown about 3 to 4 quarters ahead of a recession. Then you have liquidity breakdown kind of simultaneously around that, or maybe a quarter after that. And then you have growth breakdown. Then you have stocks breakdown. Then you have employment breakdown. Then you have credit breakdown. Then you have inflation breakdown, which typically happens somewhere around 3 to 4 quarters. 4 to 5 quarters actually after a recession has started. So the key takeaway from this analysis is that you should not, as an investor, expect a sustained breakdown below trend in inflation in the absence of a recession. In fact, there is no, in all these, so this is the median value from the 12 or 13 business cycles that we've had in the U.S. economy since in the post-war U.S. economy. And in fact, there is actually no business cycle in the post-war U.S. economy where inflation broke down sustainably below trend before recession started. And so we do not believe there's a high probability of a recession over a medium-term time horizon, which in our nomenclature is 3 to 12 months from now. And so as a function of that, we are expecting the inflation time series to cycle lower over the coming months, bottom and start to meander higher in Q4 and really start to really materially accelerate in the first half of next year.
Yeah. So Darius, in relation to this recession discussion and the spillovers to inflation, we've seen a couple of months in a row with rising unemployment in the US economy. We've even triggered the so-called Psalm rule. The author of that rule, Claudia Psalm, released a blog immediately after the rule being triggered, saying it was not meant to be triggered because we have an increasing labor force and that's not how it's designed. So how do you view the unemployment rate, the labor market, and the spillovers to inflation in relation to this recession discussion?
Yeah, it's a great question, man. And we actually we published our lead-off morning note. I want to say right before she posted that blog, or sorry, right after she posted that blog. And our analysis was we shared the same conclusion, which is that the unemployment rate is rising primarily as a function of the growth of the labor force, not as a function of the growth of people getting fired from the labor market. Now, we understand, however, that the labor market is cooling, it's softening, but we, again, as I mentioned, we do not see elevated risk of a recession over a medium-term time horizon based on the current, based on the persistent leading indicators of the business cycle and how they are currently trending. So if we go to slide 37 or 27 here, Nick, we show that same analysis. So again, the median trailing 10-year delta adjusted Z-score in months before and after recession begins. These are some of the higher frequency variables in the labor market that have been proven to be leading indicators for the broader business cycle. So in terms of these indicators, temporary employment is kind of the longest lead indicator. Then the University of Michigan Employment Survey breaks down. Then cyclical unemployment breaks down. That's the total number of people who are on total number of unemployed that have either just been fired or they have completed temporary jobs. Then you have the Conference Board's labor survey breaks down. Then GDP growth breaks down. And then you have initial jobless claims, continuing jobless claims, and so on and so forth, breaking down with employment being the most lagging variable in that particular process. And so if you can see how they're currently aligned today, you can see that these leading indicators are, sort of slowing and below trend in the way that growth is not. So we would expect over the medium term for growth to catch down to how these indicators are currently performing. So that's kind of step one. We do expect the labor market to continue softening. But as I mentioned earlier, we are not of the view that the economy is heading into trend. So, and as I mentioned, this is how the business cycle is currently performing with respect to that business cycle analysis that we highlighted earlier. And as you can see here, the leading indicators of the business cycle, specifically with respect to growth and employment, things like corporate profit cycle, liquidity, and the policy, with the exception of the policy rate, those things are not necessarily suggesting that we are heading for a business cycle downturn. You would expect to see the chart on the right in these analysis look more like the chart on the left if we were in fact heading to a recession, let's call it 3 to 4 quarters from now. And right now, it's just very much not the case in terms of how the business cycle is performing. If you look at the corporate profit cycle specifically, which is one of the longest leading indicators of the broader business cycle, the corporate profit cycle right now is in a ubiquitous, accelerating upturn right now. So if you look at how that cycle has historically performed, Nipple corporate profits have lead our corporate profitability model, which is how we track corporate margins on a real time basis, which follow with growth. It follows that, and then you have household net worth breaking down, then S&P 500 trailing 12-month earnings breakdown, then next 12-month earnings breakdown. Then you finally get the breakdown in gross domestic income and corporate net worth, and just none of that stuff is happening right now. In fact, we have the opposite happening right now in terms of a ubiquitous upturn in the corporate profit cycle. And so in our opinion, we don't think there's limited recession risk over the medium term from this variable either in terms of this leading indicator of the broader business cycle. And then finally, I'll say non-farm productivity, when you look at some of the other indicators in the labor market, the more slower moving, lower frequency variables like non-farm productivity or private sector hours worked, those are the two longest leading indicators within the labor market cycle, non-farm productivity and hours worked. In the breakdown, let's call it 2 to 3 quarters before, 2 to 3 quarters for hours worked, 3 to 4 quarters for non-farm productivity before a recession begins. And again, this is data using all the data that we have available from the post-war U.S. economy to determine how the median path of these indicators have taken prior to recession. And we have a ubiquitous upturn, an accelerating upturn in non-farm productivity. Private sector hours worked are below trend. And so we would expect growth to kind of catch down towards that, but they're not, the direction of travel is not in a way, one that suggests we are likely to have a recession over the medium term. So that's kind of a long-winded, data-driven way of saying the bear porn that a lot of investors are sort of suffering from out there in terms of not being able to make money on the long side of risk assets. In our opinion, that bear corn is misplaced. But at the end of the day, it's never going to go away because that's how bear corn purveyors get paid.
Yeah, you're absolutely right, Darius. When you look at the unemployment rate, assuming that there is an actual increase in unemployment and that we cannot just explain this away with an increase in the labor force. As an investor, it's obviously sad that we see an increase in unemployment. But as an investor, does the unemployment rate even hold any signal value when you asset allocate?
I would argue no. And so going back to our business cycle analysis here on slide 30, the market cycle. So stocks tend to break down. If you're late in the business cycle, stocks tend to break down before the overall employment cycle. And so if you understand that, you should not be looking at things like the labor market to figure out where the markets are going. That if you're going to figure out where the markets are going, you have to pay attention to the cycles that lead the market. And that's the policy cycle, that's the corporate profit cycle, that's the liquidity cycle, and then ultimately the GDP growth cycle. And those cycles are, as I mentioned, are not aligned in a way that suggests we're going to have a significant breakdown in stocks over the medium term. Now that will eventually change. We'll use the same exact analysis to say, okay, things are changing and evolving in a way that suggests we are headed for something that's really materially negative. But for now, again, I think it's just misplaced to be focusing on the employment cycle as a leading indicator for stocks, because that's not how the business cycle works. The business cycle works in the reverse order relative to kind of the bear point we're hearing out there. And then one thing I'll say, actually two things I'll say with respect to the labor market cycle, because while we're on the subject, I think it's an important thing to unpack with respect to this kind of labor hoarding phenomenon, which has been a contributing phenomenon to the resiliency of the U.S. economy, with something we've been highlighting throughout the duration of our resilient U.S. economy theme, which is almost 2 years old now. And so if you look at this chart here, where we show on slide 37, we show Joe's total job openings divided by total unemployed workers. That number's right. It's been slowing sharply for the past couple of years, and it's kind of nearing a trend level. The private sector hires rate, that's at 4.1%, and that's below trend now currently. The private sector quits rate, that's at 2.3%. That's below trend. So all these things are suggesting that there's slack being created in the labor market. However, we are not seeing people get fired in the labor market. And that's where we get this concept of labor hoarding from, because historically speaking, when you've seen slack created in the labor market, it's usually done through the actual layoffs and discharges rate rising, which it's not. It's actually at an all-time low of 1% in the most recent month. And you also see total employment falling, and it's not. Total employment continues to meander higher, whereas total job openings continue to grind lower. So this is the first time in the history of the time series where we had a significant divergence between the hires rate and the quits rate from the layoffs and discharges rate. And it's also the first time in the history of the U.S. Labor market time series. And again, these time series only go back to 2001, so it's not a lot of business cycles, but it's noteworthy that it's happening for the first time here, is that we have a divergence between job openings and total employment. So in our opinion, these divergences are not going to resolve themselves until we get an inflection in the corporate profit cycle, because again, we know the corporate profit cycle leads the broader GDP growth cycle, which leads the broader employment cycle. Right now, as I mentioned earlier, we see the corporate profit cycle is in a ubiquitous upturn, as evidenced by the trends in NIPR corporate profits growth and our corporate profitability model, which is a proxy for corporate margins. So finally, just kind of wrapping up, I'll take you to our grid model here for the U.S. Again, we see growth slowing over the medium term. We just don't see growth slowing as fast as consensus is expecting growth to slow. We're kind of getting towards the bottom of the sine curve with respect to inflation. And by the kind of the first half of next year, our projections are suggesting that inflation is likely to materially diverge, as I mentioned. So it's an interesting setup. We're not as concerned about the economic outlook as a lot of investors, but we are more concerned about the medium-term inflation outlook than most investors. And so that probably means that, we are probably going to have less policy rate easing on a next 12-month type of investment horizon than it's currently priced into markets. And so I think that's one key takeaway investors should probably take away from this discussion.
Yeah, good point, Darius. I read an article written by one of our colleagues at Bloomberg. He made a very simple study on the historical returns if you bought equities exactly at the date where the Claudia Sam rule was triggered. And it was a very, very good timing to buy equities, actually, historically. So it goes to show that you're absolutely right, that this is a lacking component to look at in your asset allocation approach. But I want to ask you this, Darius, because I mean, we have a lot of moving parts in the US economy right now with unemployment on the rise. It is very easy to get worried about the economic outlook. And I get why a lot of people get worried about the outlook when they see headlines of rising unemployment. So how do you structure your asset allocation approach to sort of avoid being dragged into taking decisions by your feelings in such a scenario, if you know what I mean?
Yeah, no, that's a great question, Andreas. So as you know, we're very systematic here at 42 Macro in terms of how we help clients manage assets. We have two separate processes that we use to help clients manage assets, which is our KISS portfolio construction process, which is primarily designed to help retail investors stay on the right side of market risk, and then our discretionary risk management overlay, aka Dr. Mo, which we use to help professional investors and sophisticated retail traders stay on the right side of market risk. So with respect to where we currently are in our KISS portfolio construction process, we are currently at, you can throw the slide up on 11, Nick, slide 11. We're currently at 40% cash. We're at 50% of our max exposure of 60% in the equity market, vis-a-vis the SPY ETF and KISS. We're at 100% of our max exposure of ag fixed income in the equity in the fixed income market, vis-a-vis the ag ETF. And we're currently at 0% of our max exposure, 10% in the Bitcoin asset class, vis-a-vis the FBTCF ETF. So, when we last spoke, I want to say we were probably maxed out on both of our in equities and Bitcoin positions. So obviously, since we last spoke a couple of months ago, those signals have come down, and they came down appropriately. Back starting in late June, our KISS portfolio construction process, which again is a systematic trend following process that incorporates our two most powerful models, which are our volatility adjusted minimum signal and our global macro risk matrix market regime nowcasting process, to infuse volatility targeting, dynamic position sizing into this process. And those signals told us to start taking down equity risk in late June. They told us to start increasing our exposure to fixed income in early June. And then, of course, right before the big collapse we saw in Bitcoin, we got out of Bitcoin. So that was, obviously, sometimes it's better to be lucky than good, but I don't think there's luck involved. I think the reason those signals, helped clients stay on the right side of market risk and book some really impressive gains in Bitcoin and equities dating back to when we got long those dates in the fall of last year in this process. One of the reasons for that is because, again, it's relying on these very powerful signals. Our volatility adjusted momentum signal helps clients have a 96% upside capture ratio in the stock market and a 98% upside capture ratio on the crypto market. And with respect to our market regime nowcasting process, that process gives us a 97% upside capture ratio in stocks and 109% upside capture ratio in the crypto asset class. And obviously, this is optimized across the various asset classes. We're just showing you these two back tests here on the slide. So that's KISS. That's where we are with KISS. So this is kind of the simple to execute three, three asset class process, 60-30-10 process that we use for retail investors. That's kind of the easy thing. That's the easy thing to do. If you are a professional investor or sophisticated retail trader and you are more your investment mandate or your investment preferences more aligned with picking factors long and short, we use our discretionary risk management overlay as a market timing and position sizing guide for those factor long short bets. So you mentioned earlier we have a systematic way in which we help clients manage risk in markets. And right now that systematic way is sort of through the combination of the market regime and the volatility adjusted momentum signal. So what this model does, what Dr. Mo does for investors, is it prescribes a proper trade recommendation for all the major factors across equities, fixed income, currencies, commodities, and crypto, according to how the current volatility adjusted momentum signal for that particular factor is performing relative to how it should be performing in this hybrid market regime. And so when we say Goldilocks with deflation characteristics, that just means investors should be betting on Goldilocks in asset allocation terms, i.e. the broad beta of the market, and betting on deflation in factor leadership terms, i.e. expecting defensive factors to lead within the equity and fixed income market. So it's kind of a hybrid of two market regimes, and we're doing our best for clients to make sure that they stay on the right side of the market risk. But let's just kind of pick on a few asset classes that I think investors really care about right now. And so if you look at something like the SPY, that's currently a short half position because the SPY ETF is neutral from the perspective of our volatility adjusted momentum signal, and it should be bearish in this sort of hybrid Goldilocks with deflation characteristics market regime. If you look at something like mega cap growth, however, the Qs, that's a long half position because historically you've actually had significant outperformance and positive performance in mega cap growth in this hybrid deflation, in sort of a deflation style market regime. So that's one bet investors should be making. If you kind of think about this from an equity sector perspective, the sectors you should be long right now are consumer staples, the healthcare, technology, and utilities. And then the rest of the sectors you want to be short or out of as an investor if you're making factor long short bets. From a factor standpoint within equities, you can be long dividend compounders, long large caps, long mega cap growth, long quality. And then you want to be short or out of things like just your standard growth, not your mega cap growth, your high beta, your low beta, mid caps, momentum, small caps of value are all things you want to underweight or be short or out of at the current juncture. Most international equities tend to underperform when you're in a deflation style market regime from a factor leadership standpoint. So though Dr. Mo is recommending either short half positions or short max positions for those particular exposures within the fixed income market, still also oriented towards deflation. You want to be long max position in things like 1 to 3 year treasuries, 5 to 10 year tips, 5 to 10 year treasuries, 25 plus year treasuries, TLT, broader ag, and then your short spread products, short things like BDCs, convertibles, EM local currency bonds, EM US dollar bonds, high yield credit. You want to be long international fixed income, long a half position in investment grade credit, short a max position in leveraged loans, long a max position in MBS, short a max position in preferreds. And then finally, with respect to macro, so all the macro exposures are sort of corresponding to Goldilocks, whereas all the fixed income and equity exposures are corresponding to deflation, because again, we think deflation, the factor leadership is likely to be defensive over the medium term, just given where we are in the broader growth cycle. And then, so some of the key takeaways here right now, you're no position in the dollar because the dollar is currently bullish from the side of our volatility adjustment momentum signal, but it shouldn't be bearish. And I suspect it will eventually turn bearish over the medium term, just given our views on where policy's headed over a short to medium term time horizon, not necessarily over a long to medium to long term time horizon. Right now, it's got no position in Bitcoin, no position in Ethereum, because those volatility adjusted momentum signals are currently bearish there. And when our volume signal is bearish on those assets, you tend to have negative performance. You have negative performance in the stock market and the crypto market when you have negative VM signals. And when you're in a risk-off market regime, you tend to have a negative or very low positive performance in these asset classes. And so how do we investors use this table, kind of just wrap it up here, it's essentially a guidepost on what you should be doing as an investor. One of the things I think we do really well, that I think as you would probably agree, the best investors on the global buy side do really well, which is keep their fundamental research views a separately oriented process from their quantitative risk management signaling. And they tend to only take positions when their fundamental research agrees with their, kind of risk management signaling. And right now, there's a lot of sort of cross currents that suggest that you can be long some defensive sectors and factors within the fixed income market, but you're not getting a lot of broad, sort of all systems go type, all things clear signals from a broader asset allocation perspective. And so that's probably why, just from a signaling standpoint, you're not seeing a tremendous amount of conviction in asset markets through the lens of our broad market regime nowcasting process. And I don't suspect that's going to resolve itself anytime soon, just given all the cross currents we talked about in the economy.
Darius, I'm running out of questions with that cross-market, cross-asset recipe you just gave there. But I wanted to ask you about the gold market and the precious metals market in particular. I've been short both copper, silver, and gold over the course of the summer. And 2 out of 3 performed very well, but gold just broke new highs late last week. Gold in a deflationary environment, or at least in a Goldilocks environment with some deflationary characteristics. How do you view gold as an asset class versus equities, bonds, etc., given where we are in the business cycle? And what do you make of that price action that we've seen lately in gold?
Yeah, no, that's a fantastic question. So you can throw slide 12 back on the screen, Nick, where we have gold. So we have Dr. Mo is currently recommending, and has been for quite a while, recommending a long mass position in gold. So as again, whenever there's a bullish condition in the underlying assets, volatility adjusted momentum signal, and it should be bullish in this regime, then Dr. Mo will say you'd be long max position in that. And the signal won't change until either the regime changes, which only happens, roughly 3 times a year, or the volatility adjusted momentum signal changes, which obviously the direction of the market could change any time. But generally speaking, these signals are pretty stable, across a multi-month time horizon. So With respect to gold, we would have investors being along a max position in gold. That very much makes sense to where we are. You mentioned that you were short silver and short base metals. We have a bullish VAMS signal and a long max position signal on silver currently, but we actually have a no signal, no position in base metals, industrial metals, because the VAMS signal is bearish and it should be bullish in this kind of hybrid Goldilocks with deflation characteristics market regime. So this is a very important sort of opportunity to kind of explain that, again, how this process works, which is if you go back and you look at our volatility adjusted momentum signal backtest for gold, investors when gold is bullish from our perspective, our volatility adjusted momentum signal, it gives investors an 89% upside capture ratio in that particular asset, and gold goes down a tremendous amount when our VAM signal is bearish. So generally speaking, you're going to want to use our VAM signal as a kind of an overarching kind of guiding light to make sure that you're making the right types of bets, long or short in asset classes. And then gold specifically has historically performed reasonably well in each of the four market regimes. And so really the only thing kind of proper trade recommendation for gold, that logic is really just a function of how the assets, the moment volatility adjusted momentum of the asset. And right now it is bullish and it has been bullish for quite a while. So investors should just be aware of that. Yeah, they had a couple bouts of neutrality earlier this year, but the reality is we've generally been in a persistent bullish uptrend in gold.
I better cut this interview short to get out in front of my screens to square my portfolio there. But I always love how you have a response ready and you're backing it up with data. That's one of the reasons why the audience loves you here at Real Vision. And one of the reasons why we bring you back time in and time out to discuss the macro markets. The final thing I want to touch upon before we leave you for the weekend, Darius, is the Fed cutting cycle. We're obviously, say, 3-4 weeks away from that cutting cycle commencing. What typically happens around such a cutting cycle commencing? Is it something that signals a major change to the regime, to the outlook for asset allocation? What, if history is any guide, what does it tell us around cutting cycles and how markets play out around them?
Yeah, great question, Andreas. So as you know, I don't have that chart in this deck today, but we did a back test on that. And how we organized the back test was we looked at the performance of the assets and the economy from the date of the initial cut, whenever the Fed started cutting in a late cycle environment as determined by inversion in the yield curve. Because I don't think it's relevant to talk about a Fed cutting cycle that was a mid-cycle adjustment or whatnot. We obviously are in a late cycle U.S. economy as evidenced by the level of the unemployment rate and the level and the inversion in the yield curve. So I want to say there were probably 17 or 18 observations in that sample that I want to say it goes back to the early 70s. And it was inconclusive with respect to the broad performance of the market. The broad performance of the market had more of it was more correlated to the broad performance of the economy as opposed to the cut being the signal. So the signal is not the cut. The signal is where is the economy headed. The second conclusion from that study was defensives tend to lead cyclicals. So typically speaking, you want to be positioned in defensives. And I think that's kind of counter to how a lot of investors are sort of trying to play a catch-up trade in small caps and things of that nature. Historically speaking, defensives have outperformed in late cycle Fed cutting interest rate cycles. So that's something that's takeaway number 2. And then takeaway number 3 is that bonds typically do well early in that process, and then they start to do not so well later in that process. And I would suspect that some of the observations that are contributing to that are instances where the Fed or the economy did not go into recession. So, it's a somewhat of a mixed bag in terms of signaling, but I want to make sure investors understand that when something is a mixed bag in terms of signaling, that is a signal in and of itself. There's a lot of, I would say, sort of incomplete analysis, to be kind, out there on the floating ground, Twitter and podcasts like these about the impact of a Fed cutting cycle. Some people say it's ubiquitously bearish. Some people say it's ubiquitously bullish, time to buy stocks. And the reality is it's inconclusive. What matters is where is the economy headed? And as we talked about earlier with respect to our grid model projections, we have U.S. growth slowing, but like expectations to the upside. You can throw the chart back on the screen, Nick, slide 42 here. We have growth slowing, but surprising because that's expectations to the upside. And then we have inflation kind of starting to bottom and then really starting to surprise consensus expectations to the upside in the first half of next year. So If you go back and you look at what is currently priced in from the perspective of the Fed's rate cutting cycles, if you look at Fed funds futures as a proxy for what the market's pricing in, the market's currently seeing right around 2 more cuts through a year in than what's currently baked into the dot plot. That sounds about right. We sort of agree with that. Where we start to disagree with the market is if you look at what's priced into the Fed funds futures by December 2025, those are currently pricing in 209 basis points of rate cuts versus 125 basis points of rate cuts to that point by what's projected in the dot plot. And I suspect the answer is somewhere in between. So you could probably see about 50 basis points of rate cuts priced out of the December 2025 December 2025 projections from the Fed funds futures market. But again, I still think that's a first half of 2025 story as investors get more confident that the U.S. business cycle is not heading into recession. And if that is the case, then we're probably going to be right that inflation bottoms at a level that's inconsistent with 2% and starts reaccelerating. But again, I don't think that's a trade we need to put on now. Right now, I think the best trade for investors to make is to position themselves according to this Goldilocks or deflation characteristics hybrid market regime. And essentially what that means is position for Goldilocks in asset allocation terms and your overall expectations of the market performance, but position for deflation in factor leadership terms, i.e. you want to be long defensives and short cycles.
Darius Dale of 42 Macro, it was such a pleasure to host you here again at the Real Vision platform. Thank you for joining us.
Thank you, Andreas. It's always a pleasure to be here, man. You guys do some awesome things for the world over Real Vision, man. So I just want to say thanks. I was grateful to be a part of your platform and grateful to be part of your community. Thank you.
It's always a pleasure, Darius. My name is Andreas Steno. Thank you very much for watching this macro deep dive. See you soon again on Real Vision.
It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world. You get to speak to the smartest people like you trying to figure this out, but also the people on stage. They're the experts. So we get all of that, all in one place, in Singapore. What more can you ask? See you at TOKEN2049.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.